Welcome to this FundForum webinar. I'm Sarah Armstrong, Editor-in-Chief of the FundForum Asia Conference. Thank you for joining us online today. I'm joined on the line with Neil Flynn, Associate Data Analytics at Shanghai-based consultancy ZBen Advisors, to discuss what information is required to help you make the most informed decision about your company's best options in Greater China. If you have any questions throughout this presentation, you can send them to us using the Ask a Question module on the left-hand side of your screen. We'll be holding a live Q&A at the end of this session. We'll also be live tweeting this webinar and encourage you to join the conversation using hashtag FFWebinar. And now I'll pass over to Neil.
Okay, thank you, Sarah, and welcome everybody to this webinar. Today we're going to be discussing asset management and ownership in China. So first, allow me to give an introduction to both the firm and myself. So ZBen Advisors is a Shanghai-based consulting and advisory firm. And we help the majority of global asset managers with their China strategy and their understanding of China's financial industries. In addition to our advisory work, we also produce daily, weekly, monthly, quarterly, and annual reports to help global asset managers understand both the domestic industry and general China strategy. Now, for myself, I lead the research and deliverable production for the Greater China investment management industry for the firm. I cover both active and passive management, as well as hedge funds, fixed income, and alts. And I've been in Shanghai now for about 4 years next week. So today's webinar is going to cover the topic of fund management ownership. Now, we're going to cover 3 aspects of this. Firstly, the broad overview of onshore presence, and within that, 2 forms. So the first one would be joint ventures, where a foreign manager partners with a domestic manager, and then the newer WFOE, the wholly foreign-owned entity. Now, before we start with the presentation, I would like to take a poll. So, of everybody listening, which of these is the most appropriate to your firm? So firstly, your firm has a presence in China, whether it be a joint venture or a WFOE. Your firm is considering setting up a presence in China in the near future, or your firm currently has no interest in setting up a presence in China. Now, the reason we ask this is because with joint ventures, typically what we saw previously was that it was mainly the largest firms that were setting these up. With the introduction of the WFOE, as I will discuss later on in this webinar, we've seen more boutique managers and mid-sized managers also enter the China asset management industry. So I would give you another 5 seconds before we check the results. All right, so the majority have a presence, and followed by an equal amount of are considering, and those that have no interest. Right, well, hopefully we can change the no interest within this webinar. Okay, so moving on to the broad overview of ownership in China. So starting at the bottom, the rep office, or the representative office, was the earliest kind of onshore presence allowed, but it was very limited in scope. Typically, what asset managers would do is that they would have a skeleton staff, and it would be used to meet up with institutional clients in order to win business for their offshore entities. As we'll discuss later, the introduction of the WFOE has effectively made this rep office business model obsolete. The joint venture. Now, there is a lot of joint venture partnerships between foreign and domestic managers across several of China's financial industries, including the public mutual fund industry, the brokerage industry, and to a much lesser extent, the trust industry. So, for example, most of the world's bulge bracket investment banks have a joint venture brokerage firm here, and the largest and most relevant JVs, or joint ventures, to this webinar are the public mutual funds. Now, many global managers have entered into a joint venture, and over the past 12 months, we've also seen a big increase in M&A activity among these joint ventures, as we start to see a bit more repositioning of asset managers' strategy. Now, the joint venture structure has a major plus point. That is, quick access to China's $1 trillion mutual fund market. You set up an operation with a domestic partner who has majority ownership, and you get direct access to the mutual fund industry. Downsides are the lack of control and, in some cases, a suboptimal working relationship between both partners. Now, moving on to the WFI. The WFI, or the wholly foreign-owned entity, allows a foreign manager to set up a presence onshore in China under their own brand name, that is 100% ownership. This obviously offers a solution to the joint venture's lack of control. However, as we'll discuss, it takes a much longer amount of time for a global asset manager to enter the mutual fund market than it does through a joint venture. So, just to give an overview of the public mutual fund market in China. Well, it's huge. The market exceeded $1.3 trillion at the end of last year, and this is up from $480 billion at the end of 2013. Now, if you look at the chart on the top left-hand corner, you'll see there was a big jump in 2015. Now, I'm sure you'll all remember the large equity market rally in the first half of 2015, and this sparked this jump. However, the subsequent market correction because of the subsequent market correction, we didn't actually see that AUM leave the industry. Now, this is because the mutual fund industry in China has actually matured over the past few years, and it's been able to retain and attract capital that otherwise would be left in standard bank deposit accounts. And because we've seen pretty consistent growth over the past few years, it's understandably attracted the attention of global asset managers. Now, it's often assumed that foreign managers can't compete in China's asset management industry, as it's difficult to gain a foothold alongside long-established domestic rivals. Quite frankly, this isn't the case. Of the 15 largest public mutual fund managers in China by AUM, 7 of them are Sino-foreign joint ventures. So just to give you a rundown of the list, the second largest is ICBC Credit Suisse, fourth largest, China AMC, of which Power Corp of Canada owns a stake, sixth largest, CCB Principal, ninth largest, BOC, of which BlackRock owns a stake, 10th largest, Harvest, where Deutsche owns a stake, and the 13th is Penghua, of which Eurozone owns a stake, and 14th is Full Goal, where the Bank of Montreal owns a stake. Now, the issue with all of these joint ventures is that the foreign ownership is capped at 49%. So obviously that's a minority stake. And herein lies the problem. If a foreign manager can only hold a minority stake, can it ever be more than a shareholder that collects a dividend payment every quarter? Now, some anomalies do exist. Invesco Great Wall springs to mind. But to us, the trend is clear. In fact, in some cases, there are some foreign shareholders that rarely talk to their domestic partner. And in one or two cases, there are foreign shareholders that are unaware that their domestic partner is running up quite a lot of shadow banking AUM to the point at which it exceeds the public mutual fund AUM of the joint venture. And obviously, this lack of communication means that you have a difficult working environment within the JV. But what we're starting to see now is that reform on foreign ownership is moving in the right direction. So Hang Seng, the Hong Kong manager, set up a 70% owned mutual fund joint venture last year and launched its first product this month. This was done through a bilateral agreement between Hong Kong and the mainland, and obviously is only available to Hong Kong-based firms. So at the moment, what we have to consider here is that if this does expand to all foreign managers, not just Hong Kong managers, would this really be a great thing for existing JV partners? So going back to the largest mutual fund managers here in China, ICBC Credit Suisse. ICBC owns an 80% stake in this fund manager. If foreign managers are allowed to own a majority stake, that doesn't necessarily mean that ICBC will willingly dilute the stake of the second largest manager in China. And it applies to many of the very profitable JVs here. So while it appears that the JV is currently the best way to gain access to the market, it's very difficult to see how it can be used as a long-run China strategy. Now, before we move on to the discussion on WOFIs, do we have any questions on joint ventures?
Yeah, I have one here for you, Neil.
Yep.
Do we expect to see more countries get majority ownership reform?
Well, I guess it's difficult to say. I mean, what we tend to see is that when you have large bilateral talks with China and certain countries, for example, the US or the UK, we do tend to see some major financial reforms come out. What we have seen, particularly with the UK and the US, is that dialogue has been made that states that China is working towards majority ownership. However, that's not particularly defined in terms of when it will happen or how it will happen. So I guess what we focus on here is more of a broader ownership reform for firms of all countries rather than country specific. And I guess as well with Hong Kong and the mainland, the CEPA agreement has been going on for years. So while certain firms are able to use that, we don't think it will remain Hong Kong specific in terms of majority ownership.
Thanks, Neil. That's all we've got for the time being.
Okay. Then we will move on to the discussion of WOFIs. So there are three common types of WOFIs, and I will show it on the screen here. Right, so starting at the bottom, the most common type of WOFI is the investment advisory WOFI. Now, many foreign asset managers have this, as it was for some time the only WOFI available to asset managers. However, the scope is limited. You can't raise or manage capital with this form of WOFI, and it's therefore commonly used for institutional client sales or servicing. Now, moving up the list, we have QDLP, which allows the foreign manager to raise capital from domestic investors to channel into flagship funds overseas. This is typically used by hedge funds. So, for example, Winton, Oaktree, Canyon. We've also seen products from BlackRock as well. This is an improvement on the investment advisory WOFI. However, fundraising is capped by an individual quota assigned to each manager. But more importantly, the QDLP WOFI is most sensitive to Chinese regulations on capital outflows. Now, as I'm sure you've all read in the news over the past few months, it'll be no surprise to you to hear that fundraising from this channel is very restricted because it's become very difficult for domestic investors to invest overseas. Now, moving on to the investment management WOFI, this is the newest form, and it's the one that excites us the most as a firm, and what we think will be one of the benchmarks for firms going forward when they develop their China strategy. We saw the first one set up by Aberdeen Asset Management in 2015. Now, this allows a foreign asset manager to raise and run domestic capital in China. This is because with this structure, a foreign asset manager can register with the domestic hedge fund industry body and therefore be treated as a domestic hedge fund. So if we look at the dozen or so managers that have this, Bridgewater aside, most of the holders aren't hedge funds. But this is an important point. A domestic hedge fund can apply for a mutual fund license after 3 years of operation in the domestic hedge fund industry. So at this very moment, we are about to see the first global asset manager, Fidelity, enter the domestic hedge fund industry. So we believe that in 3 years, there will be a 100% owned foreign manager in China's mutual fund industry, which will be a huge milestone from where China has been in the past few years. Now, this all sounds very good for managers with this IM WOFI and those looking to set one up. However, managers with an existing investment advisory WOFI or a QDLP WOFI are somewhat left in limbo. They have the onshore entity, of which is staffed, but it has much less functionality than the investment management WFOE. Now, we originally believed that these two forms of WFOE could be converted into the investment management WFOE, and we got proof of this in November. The Korean manager, Murray Asset, successfully converted its investment advisory WFOE into an investment management WFOE. So, given the large number of global asset managers in China with an IA WFOE, for example, BlackRock or Schroders, we expect to see a lot more conversions in 2017. So what we can see now is how the WFOE itself fits into the spectrum of Chinese asset management. So on the left-hand side, in the mutual fund industry, it can only be accessed by a joint venture in the perspective of a foreign asset manager. And this is obviously with the minority stake. Now, in the mutual fund industry, you can access the retail investor, China's huge retail investor base, through a public mutual fund, and you can also access, for example, the high net wealth investors or the institutional investors through a fund management company's segregated account business or a subsidiary business. Now, something that's actually quite interesting that's happened over the past 12 to 18 months is that we have seen huge bank mandates entering into the public mutual fund industry. Now, just to give some context to this, we've seen some of the largest ever fundraising in this public mutual fund market over the past 12 months. For example, ICBC recently had a fixed income fund that raised 40 billion RMB within the space of around about a week, I believe. Now, on the right-hand side, we see the private fund industry or the hedge fund industry. Obviously, the investor scope is much more narrow, but it's something where a WFOE or a 100% owned foreign manager can access. There are one or two cases where you can have a joint venture hedge fund, although this is a very rare occurrence, and the type of institutional capital you can raise in this industry is more restricted than in the mutual fund industry. So while it may seem that China's hedge fund industry is, I guess, a stepping stone to the public mutual fund industry, it's actually an incredibly attractive market in its own right. Part of the intrigue of how global managers will begin to raise and run money in China is the industry they're entering. So the industry itself has experienced impressive growth over the past 2 years, just shy of 200% AUM growth to reach around about $400 billion by the end of last year. Within that time, regulators made efforts to formalize the industry. It wasn't uncommon to hear of stories where a private fund was raising large amounts of capital and it turned out to be a one-person operation out of a hotel room. The industry body, AMAC, has imposed much stricter regulations now on the industry. And what we expect is that the entrance of established global asset managers will further help the regulator to set the bar higher. But something that's also quite interesting here is that when foreign managers do enter the industry, what exactly will they launch in terms of their products? Now, we only have one case at the moment where a foreign manager is about to enter, and that's Fidelity. Now, from where we sit, the Greater China Fund product suite of Fidelity would be a good indicator. So Fidelity has a very strong active China equity product suite out of Hong Kong. And we wouldn't be surprised to see a similar strategy launched in the private fund industry. And this is because building a reputation and a track record should be seen as a prerequisite to entering the mutual fund industry. So what we believe is sticking to what you know would be a safe bet. Okay, do we have any questions at all about this, about WFOEs or about ownership in China?
Yes, we do. Here's one coming in. Today, Manulife has announced that it has been granted an investment company, Woofy, and claims that it is the first financial institution to get this. What do you know about this, and is this really a new type of Woofy?
Well, this is actually something that we've been looking into today. From what we understand, yes, it is a new type of. What Manulife has done here is it's done something that other investment management Woofys, that other foreign asset managers haven't done before. However, unfortunately, we're not really able to comment on this at this time.
Fair enough. So we do have another one. Would you say that JVs or wholly owned platforms are the best choice for a global manager?
Well, I guess it's not really a simple question to answer because different foreign managers have different priorities with China. So, for example, if you are in a joint venture and you're a passive investor in that, then collecting the dividend is certainly something that is suitable for you, and there's no reason to expand your China strategy to launch a 100% owned entity here and products from that. However, what we see, or from where we sit, the investment management Woofy is certainly the most flexible platform, particularly as a long-term China business. I mean, as I discussed earlier, even if you do get 100% owned, if you do get majority or even 100% owned access to the mutual fund industry, and you're already in a joint venture, it would be very difficult to assume that your domestic partner would willingly give that up, particularly if it's successful. So what we've been seeing is that a lot of managers may find themselves getting stuck in a situation while their competitors and while their peers are making better progress. An example is in the securities industry here. So we've seen a lot of investment banks that are pulling out, or that are either considering increasing their ownership of their joint venture brokerage company, and one or two that are actually leaving. And we're seeing this divergence in strategy, and it's actually going to be very interesting to see how this plays out. Now, back to the original question of JV or Woofy. The way we see it is that it's not necessarily an either-or question. A good case study here is actually JP Morgan. So it already has a minority stake in China International, but it set up an investment management Woofy in 2016. Our opinion is that the firm is set to use both entities to complement each other. And for example, should the investment management Woofy enter into the private fund industry, it wouldn't be a competitor to its joint venture firm, China International. And just to add some color to this as well, China International has been very helpful to JP Morgan in terms of selling its MRF product in China. Now, this is a channel that China's opened where a foreign asset manager can sell a mutual fund in China, and JP Morgan has used its joint venture to do that. So what we're saying, I guess, is that whereas the IM Woofy, the investment management Woofy, is the most attractive and most interesting for a long-term strategy, it doesn't necessarily mean that the JV has to be written off.
Great. We've got a couple more questions here. So there's one in here about what are the different tax implications for each of these ownership structures?
To be perfectly honest, I'm not a tax expert, so I couldn't really answer that. Sorry.
No, okay, no problem. And I've got another one here, and it's about the Manulife. Can you tell us a little bit more about Manulife's first holding Woofy platform for asset management? What is the significance of this platform? Be suitable for any manager pursuing multiple strategies in China?
Well, I mean, again, we can't really discuss too much details about this as we only really send information on this to our clients a few hours ago. But just to give you an overview, what we expect is that this is we've spoken for a long time about how there could be the possibility of having a holding structure WUFI, of which you can have different business entities within. And what we expect is that this is the case.
Okay, great.
Yeah.
That's what I've got here. So, Neil, if you want to wrap up.
Yeah, well, firstly, thanks to everyone for listening. In regards to the questions, I do apologize I can't answer much about the Manulife case as we kind of, this is client only, but I'd be happy to answer any questions you have. And just as a bit of a shameless plug, I guess, next month we do have the China rankings, which is our yearly or annual rankings of global asset managers in China. We rank firms based on the onshore business, the outbound business, and the inbound business. The report is publicly available next month. You can find more information at zebinrankings.com and just to find out where your firm is ranked compared to your competitors. That's all from me. So, Sarah, I guess I can pass it over to you. Thank you.
Great. Thanks a lot, Neil. All right, then that's all we've got time for, I'm afraid. But I'm glad to let you know that you'll be hearing more from ZBEN advisors on this topic at the upcoming FundForum Asia conference taking place next month in Hong Kong. We'll be sending you out a recording of this webinar for you to watch and share with your colleagues. Thank you, everyone, for coming along. Make sure you keep an eye out in your email inbox for information about future webinars and our upcoming FundForum Asia event. Thank you to Neil for joining us today for this discussion. If you have any feedback on today's webinar or any recommendations for future webinars, please do complete our short survey, which will flash up on your screen shortly. Thanks and goodbye.